Welcome to Seminar 4. This week we focus on financial analysis. The goal of financial analysis is to assess the performance of a firm in the context of its stated strategy and goals. There are two principal tools of financial analysis: ratio analysis and cash flow analysis. Ratio analysis involves assessing the firm's line items and how they relate to one another. Cash flow analysis allows the analyst to examine the firm's liquidity and to assess the management of its operating, investment, and financing cash flows. Financial analysis is used in a variety of contexts. Ratio analysis provides the foundations for making forecasts of future performance. As we will discuss in later weeks, financial forecasting is useful in company valuation, credit evaluation, financial distress prediction, security analysis, mergers and acquisitions analysis, and corporate financial policy analysis. We focus on two types of comparative analysis. The first is time series analysis. This is where we compare a single firm's performance over time. This allows us to identify trends in performance. The second method of comparison is cross-sectional analysis, where we compare the performance of our firm of interest to a peer firm or some benchmark comparison group. Of course, you can combine these two and compare your firm against a peer or benchmark firm over time. A key point that we stress in our discussion of ratios is that there is no single benchmark set of numbers that firms should be achieving. You need to understand how well the accounting rules allow your firm to accurately reflect underlying performance. One obvious difficulty that arises when undertaking cross-sectional analysis is trying to identify the appropriate comparison group. Remember the aim of your financial analysis. You're trying to work out how well your firm has been performing. So the point of having a comparison group or peer firm is to try and identify firms that are likely to have been doing similar things. That is, facing the same sorts of risks, having the same sorts of opportunities, and having similar accounting rules as your firm. In that way, you are trying to remove, as far as possible, differences in ratios that are not coming through firm performance. This is where your accounting analysis is important. Having an understanding of whether your firm is adopting similar accounting policies and choices as its peer firms will help you in determining whether there is underlying performance differences or simply accounting choices that give rise to differences in your ratios. Typically, we focus on benchmark firms that are in the same industry as our firm, and then might typically match on something like firm size. You'll find, though, that this is not always as straightforward as it sounds. Sometimes it can be difficult to find one good match, or even a good industry match. Your task as an analyst is to keep in mind how any differences between your firm and the comparison group could affect the observed ratios. A useful starting point for our ratio analysis is return on equity, ROE. We measure return on equity as income divided by shareholders' equity. It is an overall accounting measure of performance from the perspective of a shareholder. ROE is also useful since we know how measures of ROE behave over time for large samples. It exhibits what we call a mean reverting pattern. That is, extremely high and extremely low levels of ROE tend not to persist over time. This pattern is consistent with the way a competitive economy works. Capital gets allocated to opportunities with high potential, that is high ROE, and away from low performing opportunities. ROE is also useful in that we can decompose ROE into components that tell us something about the various ways in which managers are affecting performance. A common way of doing this is termed the DuPont analysis. In the DuPont analysis, we break ROE into three components: margins, asset turnovers, and leverage. Profit margin, income divided by sales, tells us about the success of operational strategies. How much income are we generating from each dollar of sales? Asset turnover, sales divided by assets, tells us about investment efficiency. What level of revenue or sales is the firm generating from each dollar of assets? And finally, leverage, assets divided by equity, tells us about the way in which the firm is financed. We know that there is typically a trade-off between profit margins and asset turnover, and that it can be difficult for well-performing firms to increase both measures simultaneously. Capital-intensive businesses tend to have low asset turnover from the high levels of property, plant and equipment and high profit margins, while industries such as grocery retailers tend to have low profit margins but high asset turnover. Thinking about how your firm sits against typical industry measures can help you consider how well its chosen strategy is working and how the ratios may change over time. One issue we may face using the traditional DuPont decomposition is that it does not distinguish between operating and financing assets. So measures of turnover, sales divided by assets, would treat plant and equipment the same as cash. Similarly, the measures of income do not distinguish between income generated from operations and income or expenses generated from the way in which the business is financed. To deal with this, we can isolate the operating items from the financing items in the income statement and balance sheet and use what is called an alternate DuPont decomposition. In this setting, we are focusing on measuring the operating profitability, that is, net operating profit after tax relative to sales, and the efficiency of operating assets, sales divided by net operating assets. These two items multiplied together give us the return on net operating assets, RNOA. We can then compare that figure to the after-tax cost of borrowing funds. If the return on net operating assets, RNOA, is higher than the borrowing cost, then having additional borrowing will increase the returns to the shareholders. That is, ROE will be higher than RNOA by virtue of the borrowing. We are asking you to calculate these ratios for Kathmandu before your class this week. Getting you to calculate the ratios yourself will get you a better understanding of how the financial statement line items work together. It will also be a good preparation for your work for the major project. More recently, we have observed that firms have been accumulating larger and larger amounts of cash and marketable securities in their balance sheets. This further complicates our ratio analysis. One way to deal with this situation is to incorporate a separate component for investing items. So our analysis will comprise of operating, investment, and financing effects. Again, we will go through this in class. Finally, you should undertake your cash flow analysis or analysis of the cash flow statement. The cash flow statement will give you information about how well your firm is generating cash in its day-to-day operations and the extent to which it is investing in growth and the extent to which it can meet its financial obligations. The relative levels of operating, investing, and financing cash flows will vary over a firm's life cycle. Indeed, many ratios will vary systematically with life cycle. That is, whether a firm is young and growing, mature and stable, or declining. In summary, our ratio or financial analysis allows you to undertake a systematic assessment of firm performance. You can use it to identify trends over time and compare performance to peer firms. Understanding recent performance is the starting point for making good forecasts. So the better you understand your firm's strategy and the way in which the strategy is reflected in the accounting, the better you will be able to assess current performance using financial statement ratios. We look forward to discussing this further in class this week.